My name is John. I work with Lions Prime Insurance as a sales agent, and today we're going to go over how to understanding insurance before you need it. So this is aimed at um, young adults who are transitioning from being on mom and dad's plan and trying to decide when to move off onto their own plan. Kind of the ins and outs of how to make that decision, what to take into account when you're making that decision, and just what to plan on and understand before you make that change. So let's get started. We'll step through it. If you have any questions, you can throw them in the comments. I'll take a look at them before I end the live, and I'll answer them at that point. But we'll just kind of step through what I have prepared, um, and then we'll check those comments. So why does it matter right now? Um, if you're 18, 19, 20, 25, right, you're on mom and dad's plan, you haven't been kicked off yet, why does it matter until the time comes? Or why does it matter even when the time does come? Why do I need health insurance? I'm young and I'm healthy, right? That might be your question. Um, and the reality is, health insurance isn't a chore that you can just push off. You can't wait and just do it later because you're limited in when you can make those changes. And you don't want to be without health insurance because you don't know what's coming in your life, right? So even if you're young and you're healthy and you don't have any health concerns, you are still living life, right? You're still driving your car, you're still hanging out with your friends. A single visit to the ER can be like $10,000 to $30,000, right? For just like a broken bone. Uh, and without insurance, you're just going to pay that out of pocket. They will bill you in monthly installments until you've paid it all. But without insurance, you're responsible for all of it. Insurance is a tool for you to use to make sure that you're not on the hook for all of that if something goes wrong. Um, it's also pretty common for people to be between jobs and they just let their insurance expire because they don't have one being offered to them anymore. Sometimes that's because they don't understand what's offered to them, and sometimes that's because they think it's going to be a short time and they're not worried about the gap. But the reality is, accidents don't care if you're employed. They don't care if your insurance is active or not, and the definition of an accident is you don't know what's going to happen. So it matters because don't want to leave yourself exposed to the financial risk and the stress and the heartache of not being covered when you need it. So age 26 milestone is the big question, right? So at age 26, you're going to get kicked off your parents' plan. That can work a couple different ways, but you can stay on your parents' plan until at least your 26th birthday. But just because you can doesn't mean you should, right? There are different reasons of why it might be good for you to stay on your parents' plan, and there are different reasons why it maybe is a better idea for you to leave your parents' plan and find something else. So, for example, if you're staying on your parents' plan is going to be best if you're living with your parents or in the same area, you like the doctors that they're seeing, or they're still paying your premiums and your healthcare costs, right? If mom and dad are paying for it, great. That's awesome. But the question is, what are they paying for, right? The upside to that is it's usually the cheapest route for you. If mom and dad are offering to pay for it and keep you on the plan, and they're offering to cover your healthcare costs as well, then this isn't really a question, right? Somebody else is taking care of it for you. But if there's any gray area in that, you could get yourself in a situation that's not necessarily a trap, but isn't ideal for you. I'll give you an example. When I got married at 23, I stayed on my mom's plan until I was 26. And as a result, I was on a high deductible plan, and I didn't pay the premium. My mom paid the premium, but I paid for my prescriptions, and I paid for my doctor visits, and I paid a lot more than I would have if I had went and got my own plan, because I was making a lot less money than my mom. She could afford the high deductible plan. I had a hard time covering all of the costs associated with a plan that didn't kick in until a lot of money had been spent. Um, the cons to a parent's plan are going to be you're stuck with their coverage, right? And you're not in charge of how they are paying for that. You don't have that control. So getting your own plan is going to be best for if you're living on your own, or you're moving to a new state, or your new employer offers this great plan that you can get on, or if you're making enough money and your parents are on a marketplace plan, but now you're messing with their plan, right? Because if they're on a marketplace plan, your income is going to affect their plan. That can be a reason to move off onto your own. So the pros are you're going to have independence. You're in charge of what it is. And you might qualify for, like I said, better cost plans that are going to save you money that your parents aren't necessarily going to qualify because their income's higher than yours. The cons are you're going to have to pay for it yourself. Unless mom and dad want to write you a check, then you're going to be on the hook for all of that. Okay, so how are we getting coverage? So there's three main paths. There's job-based coverage, which is going to be sponsored by your employer. Your employer is going to be paying part of the premium, and it's going to be taken out of your paycheck automatically. That's the first path, right? The other is through the marketplace. So if you're working part-time or your job doesn't offer affordable coverage, and affordable is determined by you, right? I mean, there's math to it, but if something on the marketplace is a more affordable option, you're not going to be disqualified because you're being offered something from your employer, because it only counts if it's not affordable, right? And then there's Medicaid, which is going to be state-run coverage for low-income individuals. If you qualify for Medicaid, you apply for that through the Department of Workforce Services, and they handle that. But those are the three main paths to getting your own coverage. So what's the marketplace? That's what I work with the most. It's a government-regulated shopping platform where you can see multiple plan options at once. Sometimes you'll hear this referred to as the ACA, the Affordable, because it was created by the Affordable Care Act, or people will call it Obamacare. That's what this is. So it offers discounts based on your income. So based on how much money you make, you can get a monthly tax credit that goes straight towards your insurance premium and lowers your cost every month to maintain the plan. And for young adults, sometimes that can make insurance plans incredibly affordable. I've seen $0 plans before based on income. Everybody's situation is going to be unique, but if you reach out to us, we can help you kind of look and explore those options. But someone who is just starting out oftentimes has access to a lot of potential savings. So the marketplace is going to divide all of their plans into different metal levels: bronze, silver, platinum, and gold. So we're going to go through those real quick just to give you an idea of what those mean. A bronze plan is going to be the lowest premium cost and the highest deductible, right? So your premium is your monthly cost to maintain a plan. Your deductible and your copay are going to, your deductible is what you pay out of your pocket before your insurance starts to kick in. Typically, the deductible is going to apply only to things like surgeries, hospitalizations, emergency room visits, stuff like that, lab tests. But every plan is a little bit different as to what has to meet the deductible first and what is outside of the deductible. Copays are what you pay along with your insurance. So once your insurance is paying a portion, what portion is your responsibility and what portion is their responsibility. So bronze is going to have the highest copay costs and deductibles, but lower premiums. Silver is going to be in the middle there on cost and on copay costs, with some exceptions, and we're going to get into those. So bronze are going to be great if you're a pretty healthy person, you're just looking for protection against some massive medical bill, right? That's the sweet spot for a bronze plan. You want to have these tools to say, like a max out of pocket, to say in a catastrophic event, the most I'm going to pay out of pocket in a year is $10,000, right? That's not a comfortable bill, but that's a bill you could pay off over a few years, as opposed to a $3 million bill, which you might never pay off, right? Especially if interest is a factor. A silver plan is going to be great for like families, because the more people you're covering on a plan, the more cost effective it gets. And especially low income individuals and families are going to qualify for additional cost savings. Like I said, I'm going to get into what those are and how those apply, but that's what a silver plan is. Next, you have your gold and your platinum. These are for people like your frequent flyers, right? These are people with chronic conditions, expensive prescriptions, major surgery coming up. These are high premium cost, high monthly cost, and significantly lower deductible and copay costs. The only difference between gold and platinum is how much better those get and how much more expensive they get, right? But the important thing to understand is these metal levels are not, they don't have anything to do with the quality of the medical care you're going to get. A doctor is not going to look at your plan and say, oh, you have a gold plan, well, you get the VIP room, right? Or, oh, I don't work with bronze plans, right? No doctor is doing that. The metal levels don't have any effect on the type and the value of the care that you get. They're only an indicator to make it easier to slot yourself into what kind of coverage you're looking for, right? It's just a way to put them into tiers so that you can easily shop for the kind of plan you're looking for. So some ways to save money and reduce costs. I mentioned the premium tax credits before. Those are the tax-based subsidies that you get every month to lower the monthly cost of your plan. Those are based on your estimated income. Emphasis on the word estimated. When you're filling out an application for the marketplace, it's going to ask you how much you make a year. You get to put whatever number you want there. But if you're wrong, you can kind of shoot yourself in the foot. If you say that you only make $20,000 a year and you end up making $40,000 a year, then the amount of tax credits that you get throughout the year when they think you're only making 20,000 are going to be pretty high. And when you file your taxes and you ended up making double that, the IRS is going to recalculate how much you should have gotten, and they're going to ask you to pay back the portion of that that you no longer qualify for. So you will end up paying the same amount whether you uh, estimate correctly or not. It just depends on whether you pay it in monthly installments or whether you're slammed with it all when you file your taxes. So we don't have to be exact, but we do want to give an accurate estimate, and there are ways to update that mid-year if things change. So you're not locked into that. We just want to make sure we're being as honest and upfront as possible so that we don't end up putting you in a hard situation when come tax time. So cost sharing reductions are those things I talked about that make silver plans better. So at certain income levels, you're going to qualify for cost sharing reductions, which essentially take deductibles, co-payments, co-insurance, and lower those amounts. So those percentages of how you're splitting your payment with your insurance company on a silver plan get way better if you're qualifying for CSRs. Your deductible comes down if you qualify for CSRs, and they don't increase the cost of the plan. And they're not assigned a dollar value. So if you are incorrect in your estimate of your income, you're not paying back a portion of those CSRs. You qualified for them when you applied, and you still get to benefit from them. But those CSRs only apply to silver plans. So that's one of the reasons why silver plans are really good for low-income families or medium-income families, because you're getting access to those CSRs, and it makes the plans a lot closer to the silver and gold, to the gold and platinum plans without that cost. And then all of these marketplace plans are going to be tied to how you're filing your taxes. We don't need to get too much into the weeds, but it is important to understand if you have a marketplace plan, how you're filing your taxes is very important. Who's claiming you? If your parents and you have young adult kids and you're not claiming one of your kids and you're on a marketplace plan, it's going to bite you in the butt. If they're going to be covered on your plan, you need to be claiming them. And vice versa, if you're a young adult who's off on their own and you're on your mom and dad's plan and it's a marketplace plan, you can't claim yourself on taxes or they're going to end up owing money back. You need to let them claim you. Or if you want to claim yourself, you can get on your own plan. And like I said, you might qualify for some savings. But taxes become a really big thing because tax credits are being used to pay for part of the premium before you even get the bill. So we want to make sure that we're being as accurate as possible when we're doing these, but that's what Lions Pride is here for, and we're going to help you. Okay, so let's move on. So when is it time to make the switch? The first trigger is going to be your income. If you're on your parents' marketplace plan, like I said before, then your financial lives are linked. They have to be claiming you on their taxes, which means if you make really good money, you're reducing how much tax credit they're qualifying for. You're raising the cost of their plan. Now, maybe that's fine, but maybe it's not, right? And so if you start making enough money that it makes sense to move you off onto your own plan and claim yourself on your taxes, your parents can keep their premium where they're expecting it, and you can qualify for your own plan at whatever premium is fair for the income that you're making. And then the other issue is if your parents make good money and you're on their marketplace plan, even if you're not making a lot of money, their plan they might have chosen a bronze plan with a high deductible because they want to save the money on the premium. But you might not have the money to pay for those things. You may need a plan that has a lower deductible. So getting off onto your own plan can put you in a better position to get access to a lot of those savings that your parents might not qualify for because they make too much. But if you're not making a bunch, then you maybe do, right? You might qualify for those CSRs on a silver plan and be able to get a plan with a really low deductible and low copays for not a lot of money because of your personal financial situation. But in order to get access to that, you need to separate yourself from your parents on taxes financially. Another trigger that's going to tell you when it's time to move, when you turn 26. That's the milestone. That's the deadline, right? So there's two different scenarios. If your parents are on a marketplace plan, you have until the end of the year that you turn 26 before you get kicked off the plan. If your parents are on an employer plan and you're on it with them, then you're going to get kicked off that plan at the end of the month that you turn 26. Now, when you turn 26, you're going to have a special window when you can sign up for a plan. So it's not like you're going to be kicked off and have no other options, but it is important to understand when you can expect that to happen. Marketplace plans, I recommend you get off your parents' marketplace plan during open enrollment the year before you turn 26. The reason being, it's going to simplify everybody's taxes for that year they turn 26 so that you guys don't have to talk to a tax professional to split out tax credits for the portions that your parents were taking care of you and the portions that you're claiming yourself, it's possible to resolve, but it's easier to just do it before the year you turn 26. So when you're 25 and you hit October, November, December, that's the time to start picking your own plan for the next year. That's my recommendation. When you drop off your parents' plan, it's going to happen automatically if you don't do anything else, and it's going to happen at those triggers, either the end of the year or the end of the month that you turn 26. And then it's going to open up a 60-day window for you to choose your own plan when that happens. The next trigger is going to be your relationship status and your tax filing. Milestones like marriage and kids are going to change the rules because there's no plus ones on your parents' plan. You can't have a kid and put your kid on grandma and grandpa's plan. That's not allowed. You can't get married and get your spouse on your mom and dad's plan. So once you've tied yourself, like once other people are involved, you need to be planning as a family for that, right? If the other thing to understand is if you get a marketplace plan and you're married, when you file your taxes, you cannot file as married filing separately. If you do, you will pay back all of your tax credits. You don't qualify for them unless you file as married filing jointly or as single. Because of that, you just need to make sure that you don't file in a way that ends up costing you a bunch of money, right? So if your spouse is still on their parents' plan, but you can't be anymore, you can still get your own plan. You just need to include your spouse and their income when you're estimating your income and when you're looking at plans, right? So that we can get you the right tax credits and we can make sure that you're not going to get slammed with paybacks when you file. So you can file as married filing jointly. So you can't just buy health insurance whenever you want, because otherwise people would buy insurance on their way to the hospital, right? Insurance only works because people pay for it the months they need it and the months they don't need it, and they're sharing the risk and they're pooling it, right? So because of that, the system runs on really strict enrollment windows. So there's open enrollment. That's the regular window. That's for everybody. And that runs from November 1st to December 15th. During that time, you pick your plan that's going to start on January 1st for the next year. So everybody has access to that. It's the busy season for insurance agents. We're going to reach out to you if you're a client. We're going to talk to you because plans change every year, right? Even if you already have a plan, we're going to reach out to you and talk to you because we want you to understand what's going on with your plan every year. But that open enrollment period is a great time to start your plan, especially if you're going to turn 26 the next year. The other window to make the switch is during one of those 60-day windows. So there are a lot of life events that are going to trigger what's called a special enrollment period. These are exceptions when you can suddenly make changes to your health insurance immediately. It's a 60-day window. So the most common are going to be getting married, losing health coverage, turning 26, having a baby, right? Those are the easy ones, right? You get married, awesome. For 60 days, you can sign up for a new plan, you and your wife, you and your husband, you and your spouse. If you lose your coverage because, let's say you have an employer plan and you lose your job, you have 60 days to fix it. I cannot tell you how many people I've talked to 6 months after they lost their job. Now they're thinking about insurance, but that 6-day window's passed. So now we have a whole new ballgame to try to figure out. When you lose your health insurance, call somebody, get it figured out, reach out to us. We're not judging you. We're just here to help. When you turn 26, like I said before, another 60-day window. When you have a baby, a 60-day window. So if you're having a second child or a third child or whatever, that's an opportunity. One, you can add your child to your plan for those 60 days. But number two, you can change your family's plan completely, right? Maybe your financial needs have suddenly changed because your baby's born and they have more medical needs than you thought they were going to have. You can change that, and a baby being born is a unique window because it's retroactive to the date that the baby's born. There's also changing jobs or moving to a new area. These things can trigger a special enrollment period, but only if you already have a plan. They're tied to you losing access to the coverage that you had before because of the change in job, the change in income, the change in area, right? If you move outside of your service area from your plan, you can pick a new plan. But just because you moved doesn't mean that I haven't had insurance in 6 years, but now I can get it because I moved, right? You have to be losing your coverage and still in order for that to trigger enrollment period. So how do you start coverage? Step one, before you shop, you're going to gather some stuff. You're going to need your social security number. You're going to need a realistic estimate of what you make for the year, and that's going to be your whole household. If you're married, that's going to be you and your spouse. If you're married with kids, it's going to be you and your spouse and any of your working kids that you're claiming. The medical must-haves. So what prescriptions are you taking? What doctors do you have to see? What hospitals do you have to have access to? Those are a good thing to bring with you when you meet with us so that we can make sure that the plan that we're getting you is actually going to do what you want it to. We don't want to give you a plan. We don't want to give you a suggestion and sign you up for a plan and then have you find out a month into it, oh, this doesn't cover this specialist I see every 6 months and he's really expensive. That's a thing to figure out before we sign up for the plan. Step 2, call us at Lion Spring Insurance. We'll do the heavy lifting for you. We'll help you explore your options while making sure that you maximize the savings you qualify for. We're not making any decisions for you, but we see these plans all the time. We understand how they work and we can explain them and help. By talking to you about your situation, we can help guide you to what we think might be the best plans for you and help you make the best decision. Step 3 is finalizing your enrollment. It's the most important step. Picking a plan doesn't mean you're insured. A lot of young adults make the mistake of stopping after they've picked a plan, but if you don't pay that first premium, your plan's never going into effect. You need to activate your plan by paying what they call a binder payment. At Lion Spring Insurance, we do this for you, but we still are going to need payment information that is accurate and it's going to have money there so that we can make that binder payment. If that gets missed, your plan doesn't go into effect, and if your 60-day window has passed, you might be up a creek. And then step 4 is keeping the system updated. It's not like a set it and forget it kind of a thing. If you move, if you get married, if you have kids, if your income changes, you get a huge raise or you lose your job, these are things that you got to let us know so that we can make sure we're operating with the most knowledge possible and we're helping you to make the best decisions possible. If you get a big raise and that means that your premium is suddenly going to go up by $300, maybe that means you want to downgrade your coverage because you want to hold on to more of that raise. Maybe it means you're fine with it. But if you don't know that getting a raise is going to raise your premiums, it won't raise them. You'll just pay back those tax credits at the end of the year, like we talked about before. So keep us updated. We're here to help support you in making the best decisions possible, right? And that's it. It's pretty straightforward. We here at Lions Pride are here to help whenever you need it. We want to answer your questions. We want to help you find the best plan. And if the answer is stay on your parents' plan, that's the answer we want to give you, right? We are here to make sure that everybody who's making decisions about insurance is making the best one, right? So I promise I don't bite. We're a nice group here, so give us a call if you have any questions or need any help. And we look forward to chatting with you guys.